of you have joined us. Sorry about last time. I was not feeling very well, so I had to cancel the lecture. We will have one over the week. We are on a seventh. We have three more, I think. We have three more left with today. So as you know, we've gone much faster than last year. But I've been marking the last year's paper and they've done very well. So I think because there was a lot of discussion during the class, and so most of the topics we discussed in depth, and I saw the quality of that discussions in the answers. However, so we tended to go faster because I think this time that we didn't go into such sort of deep levels of engagement. I mean, that's just a function of the type of experience that that the participants bring in, and so, but that's okay. But what I decided was not to sort of increase. My initial plan was to like go in depth on some of the topics, but I feel that in doing so, you also have the other side of studying too in depth for the requirements of this course, and you will be having a much heavier load. Sorry, you will be having a much heavier load than your the class the year before you, which I don't want to do to you as well, because I want to sort of have a consistency throughout the course, so that I don't want last year to be like one level and then you have so much, like a much more expanded syllabus. So because of that, I am going to just today is going to be a shorter lecture, much shorter lecture, because I want to sort of slow down the pace, because even last time we finished really fast, like a lecture that I actually had 1.5 lectures the previous time to do. We did it with enough time to sort of do half of today's lecture as well. So I am not going to sort of pack another part of a lecture into this. And so we are just going to sort of stop early today. So we'll quickly go through last time's and then finish off today's. And I think we will have more time. So there was a part in the legal section that I had left out for later, which is on the data protection and the ancillary laws. I'm going to bring that in today. Because we're also going to be talking about identity sharing and personal information sharing, because we'll be talking about blockchain today, right? What you all have learned or anything that you want to clarify, because we are coming towards the end of the course. So the way I'm going to do it is the last lecture is going to be kind of like a revision. I decided last time I didn't have a revision, but also, I mean, I had a very small revision, but also because we were sort of having a continuous discussion, it was okay. But this time we are studying a bit more on some of the areas, so I thought we will have a revision as well. And you can clarify anything there as well. So are there any questions before we start, or I can just straight away go into the phase of time object? If there are any questions, please ask. Right. I will quickly recap with last time. Who was there? Rangana, you were there last time, no? Were you? And I think Mr.
Uh,
Rajka.
I
Was there?
missed it.
You were not there, Rangana.
Yeah, I was
Because I
not.
told you about very few turned up, and we have Dilshani after a long time, and Visista is. Visista, were you there last time?
No, ma'am.
Okay, no, that's okay. Okay, so we'll recap what we did last time. I have sent all the presentation. Today that's what I did in the morning. I went through all the presentations and I sort of changed the order. So though today we're doing what is called lecture 8, but today I think is the seventh like lecture, but we are already on lecture 8, right? So we are going to do, because we did half of lecture 8 last time, so we've been going really fast. That's why I just want to slow down. And so feel free to ask any questions, right? Because once you if you don't ask questions, and then if something happens at the exam, I can't help you at that point. I mean, I'm very fair in giving marks, but um, if it is wrong, it is wrong, right? So yeah, okay. So let's quickly recap last time, because several of you were not there. Mr. Rajkarna was there, right? I think he was there. I remember
I'm
him.
sorry that I was not there.
Are
The
you
last
also not there?
part,
But
yeah,
who
at the
was there?
part
I
of the
can't.
lecture, the part of the lecture I was
Was
there,
I
but
talking to myself?
later I was signed off.
That's okay. Right. So let's quickly recap last time. And so I guess we can do lecture 8 proper also, if none of you were there. So this is what we did last time, right? So the previous time, I think several of you were there when we studied innovation, the theory part of it, about um, what did we do? Here we are. So I put this as lecture 7 because it is the theory part of it, right? So we did this, which was the crux of now with fintech. Fintech, can someone explain to me is the major difference between fintech firms and traditional banks or traditional payment service providers or financial service providers? How can we, their business models or their innovations or their products, what distinction did we talk about? Can someone tell me? Any guesses, at least, from based on what we've learned? Any guesses? Okay, can someone tell me? Let's go to the basics, because there's no point in going forward if you don't know what we're talking about. So, what is fintech? Can someone tell me what fintech is? No? Any ideas on what fintech is? Gangadu, anything? Nothing? Am I heard? At least. Can you hear me? Let's see.
It is a digital platform that is involved in financial services.
A digital platform that is involved in financial services. Correct. What is the difference between a bank and a firm that we would call a fintech? Like what different? How can we catch on some difference?
So that will be totally based on, I mean, that is based on digital platform, not like the banking, the fairs and things like that. So that is completely based on the digital.
Yeah, so I think that is also a good observation that there's a lot of it. We can say completely, and also sometimes not, perhaps not completely. There may be some points that you have to still do manually. Like for instance, if you are doing a payment app, right? Until 2020, late 2020, you had to do manual KYC. So that's why if you take apps like FreeMe, who were the first entrance to the payment app market, when you start a FreeMe account, the FreeMe representative, so you can download it online, right? But there is a component because of the regulation, because of the KYC regulation, KYC had to be done face to face, right? So the face to face KYC was a must. So therefore, you download the app, you upload your ID, you upload your photo, you do all of that. But then until a FreeMe agent comes and verifies your identity, you can't start using your FreeMe account, right? So it's as digital as possible. So it's sometimes you can't have completely digital, and sometimes your fintech might be a service to provide something physical, like mobile money, right? Easy Cash, Mcash, originally. So those were kind of the early, like fintech 1.0 sort of thing, right? There, the fintech was to allow transferring money via the mobile network, but at the end, the person is manually taking the money out. So there is a manual point at the very end of the service, right? So there will be certain points that have manual aspects, but it is largely using digital technology, right? So it's using digital technology, and apart from like the cases like Easy Cash, where you're using your telecom network because you're using USSD, and SMS-based messaging, you're using the internet, right? A lot of fintechs use the qualities of the internet and digital technology that is sort of, you can use different ways to connect to different systems because they're all standardized as digital systems, right? As software, the coding, there are certain standard ways of coding software, and when you follow those standard ways, you can interlink between systems. Now, that is the quality of technology that they use, fintechs use. So, banks can have APIs, and then APIs are interfaces where you can connect application programming interfaces, and then fintechs can connect to the banks using those APIs, right? So, and the fintechs can also have their APIs and then ask other people to connect to them as well. So, they're using the qualities of digital technology to have their connections and provide their product, right? So, that is a sort of a fundamental quality um, that you described. And another important one, the more important one that we will find is that it is sort of using this digital technology and coming up with new ways to do things that are different to the traditional business model, right? So it's really sort of innovating the traditional business model to do it in a slightly more efficient way or to target markets that are not reached by the traditional model, right? So because you have the internet, you have a cheaper way, right, to get to markets. So let's say people living far away or people who are not rich enough to get a big loan. So then they can go into sort of a crowdsourcing model. So you have different business models that are getting created with the use of the internet and the ability to reach many people just via their mobile phones or computers. So those are sort of the distinguishing features of a fintech. Now, if we go back to the theory that we looked at, so we are just recapping like 2 lectures ago, right? So this is in digital innovations, generally digital innovations, the incumbent, now in our case, would be the banks, right? Banks are the incumbents. They're the people who are already there and already established, right? So they will continue to serve. Now, in the case of banks, most of them are risk-based decisions, right? So they prefer the less risky customer, right? And they will go for the higher market, right? So, but the new entrant has all these people. You know, there are so many people banks can't give loans to. There are so many people that might not be able to access the bank through its complex, let's say, internet banking, right? So then the fintechs now have a little market, right? And at a very low cost, they can create a small app or something like M-Pesa, something like Easy Cash. M-Pesa is the sort of the father of Easy Cash. Then they can enter the market, right? Then they enter the market. Now, for instance, if you take the example of Freeme really entered the market through the youngest crowd, right? Like students or people who were going after who were most drawn by discounts, right? Or cashback. So Freeme gave a lot of cashbacks at the beginning. So if you ask the younger people, they were all like, of course, we have Freeme because we are getting cashbacks. But the people who probably had more money in their bank accounts and were not so sensitive to the cashback, didn't want to connect their bank account to this new app, right? They were like, no, it's fine, I can live without the cashback. But those who were sort of the smaller customers, and this is what, so the low end market, right? So it's least profitable, right? Now they're giving cashbacks, and so I'm talking about 2018, 2019, 2008, 17, 18, I think. And so they're giving cashbacks to all these university students. The lowest rung, the banks don't care so much about them because they don't earn money. They're getting money from their parents or some scholarship or something like this. They have a small amount of money. So, but they were the people who were using it and popularizing it, right? And they were sort of the test market. And then what happened was, as Freeme improved and developed their product, the mainstream also started realizing, oh, okay, this is safe now. It's okay. It's okay to use this. People have been using it. They're not losing their money. It's convenient. So we can also start using it. So then the mainstream, as they keep developing their product, then they reach the mainstream. As the product performance increases, they can now come into the mainstream, right? And they can keep continuing and reach the high end even, right? So while the incumbent is following this, right, this person can catch up really fast after a certain point. Now, this is the business model, the innovation model that most fintechs use, right? They will come to a small part of the market, right, and find niches, right? Like, so for it was a payment app, it was a money transferring app, and it was a payment app. So you don't have to carry cash around. It's very easy to transfer money between Freeme accounts, and you don't have like the issue of change and all these other issues. So it was targeting this very this market that was looking for low cost convenience, right? So, but gradually it managed to find a market that is not looking for low cost, but they are looking for convenience and safety, right? And that is when the product performance is going up, right? When it was established, okay, it's safe and it's also convenient, then other people also started joining in. And also it opened a market for so many other apps as well. People realized, oh, okay, using apps are fine, payment apps are fine, and that created a whole new market. And that's how the whole fintech in Sri Lanka, the payment apps really grew, right? So that is an example based sort of recap on what fintech is. Is that clear? Any questions on that? No? Right. So this is sort of this is a general digital innovations model, right? And the most important one is disruptive innovation. And now the example I gave of Freeme was a disruptive innovation, because suddenly people didn't need to go to the banks anymore. They didn't even need to use ATMs. They didn't need to go and fill slips and all of that. So that model suddenly, to a group, it became irrelevant, right? And so it was slowly disrupting the incumbents' model of delivering transfers, making payments, right? So in payments, if you all have worked in payments, there is a little bit of money that you earn when it goes around, right? And by help, and in Freeme you could then connect through JustPay, you could connect other accounts as well, right? So bank to bank direct transfers are possible, right? Otherwise, for SEFs, we had to log into our online banking and put in our passwords, get the OTP. So all that was required. Now suddenly Freeme, all that was resolved by them. So that really became a disruptive function. And then when the others started joining, the app market started developing, that was a disruptive innovation model, right? And also then what happened was the traditional banks also joined in, right? They also brought in their apps and joined that market. Right. So that is how we take the theory, and we can take an example from what we know, the fintechs that we already know, that is in our market itself. So we are not talking about sort of external, like PayPal or something like that. PayPal also is very similar model. And we can see how we can apply these theories to practice, or how these theories are applied in practice, right? And how it works, right? So that is where success is. So you go to a underserved part of the market. In these lectures, we had the next lecture, was it this one? Here the BMW and the Toyota, right? So this is based on an American study. This theory is based on an American study. So that's why they've used BMW and Toyota. So Toyota used, the Japanese car makers used a low-cost model to enter the car market, right? Like an example that we can see is the Indian cars in Sri Lanka, right? How Maruti just came in, right? I think it was in the early 2000s, and they went for the low-end market, right? And then Maruti's product performance improved. They merged with Suzuki, right? And then Suzuki also joined the small car market, right? It was not a popular car manufacturer. I think Suzuki was manufacturing, I think, bigger vehicles. But it entered the small car market, right? And from that small car market, now it has captured a lot. Now Suzuki's have SUVs and all of that, right? So this is how you enter the market. This is a way of entering the market, and fintechs also use this model. Right, so that is a recap of that question. Now let's go to here, right? So how this fintechs, this concept is applied in banking, right? Banking as a whole, how are we seeing this? So last time, this is what we discussed. So I'll quickly recap this one. So there are three main ways that we see it. One is open banking, digital banks, and challenger banks. Can anyone tell me what open banking is? If you were there last time, or if you know it from anywhere else? Anyone on what open banking is? Any ideas what open banking is? I know this you can't, it's difficult to guess when you look at this picture. You need to know what open banking is to understand this one. Let's see. So what is open banking? So open banking is what I described as when we were just at the beginning of this lecture for Ms. Rajkarna's answer, which was everything being digital, right? And I said, okay, it's standard. So when everyone has standardized software coding methods or software, then you can connect with each other. And when you use the internet, there are also standards, right? So then when you are on a standardized platform, then you can connect with each other, right? So that logic is what is used in open banking. So the word open in open banking is not that, yes, the bank is open, but how is the bank open? It is open technically, right? Through technology, right? Digitally only it is open, right? So it's not that the bank is open, right? It has now, when you will find the word open in different contexts, like open government, right? Or now when you say open government, it is transparency, right? Way to bring down corruption. There were concepts like, especially in the early 2000s, late 90s, that concept was very popular, open government, right? And then in the after the financial crisis, the concept of open data, right? Where you make data easily accessible to everyone, right? Then there is open source. Again, that is a matter of sharing your source code of the software. You come up with software and then you share it with everyone and say, okay, you can just acknowledge that you're using my software, and then you can develop it. And there are a lot of, like, even Google, all of those are developed on open source software, right? And you can build proprietary things even using open source software, right? And they can be quite good. Now, open source software means when it's open, then everyone can look at it and comment. It's like peer reviewing, right? That's why open source software becomes strong, because everyone will check for its bugs. Now, if you take open banking, the word open here is slightly different, right? Now, banks have all the customers' data inside, right? So the bank can't just be open like open source, where they share the source code of the software, right? Here, what open means is there are access points, digital access points, where you can access certain amounts of data of the bank and provide services to your customer. Now, that's why it says open banking is a practice that provides third-party financial service providers open access to consumer banking transaction and other financial data from banks and non-banks through the use of application programming interfaces, right? So the bank provides this interface, right? And you have to make certain developments to access that point. And then once you get the access, then you can access whatever data that the bank allows you to see, right? You don't get to access the entire bank's core banking database, but you will get access for permission sets of data, right? So that is open banking. So that is sort of the first application of fintech. We can talk now, first sort of like now the most common, right? So these are sort of generational, right? And so when the fintechs, the small guys, right, the new guys who are looking for the low ends of the market, the underserved market. So when they were serving, what they realized was the money is still in the banks, right? So these fintechs can't hold money unless you have a banking license or a deposit institution license. You can't hold money of customers. So the money of customers are in banks, and banks are already digital systems, right? So they can connect to those banks. And with a lot of fight in the EU, took many years, many years. The Payment Services Directive 2 was implemented in 2019, legally telling banks give access to the third parties so that they can provide customers with services that you can't provide. If you can't provide, at least let them provide it, right? So that was kind of the logic of open banking, because there were a lot of services, because banks were too big and they have, all their risks to consider and so many other considerations and compliance considerations. There were certain smaller markets that they were unable to service. So the whole purpose of allowing open banking was to let a third party do that through accessing the customer data, right? And even in Sri Lanka, we are developing an open banking framework. It originally came up in the EU and the UK, but then subsequently it's being adopted world over. So this is what this picture means. These are the standardized interfaces that I was talking about, right? So when everyone has a standardized system, you can have interconnectivity to all all participants, and you can keep sending data and receiving data and receiving solutions, sending requests. So all those the information can go to many places, and just the amount of services that can be provided becomes bigger because more service providers can connect to a single place, right? Now, in closed banking, which is the traditional banking, you have just the bank and the customer, right? So what is provided by the bank is what the customer can have. So based on whatever money is in the bank, whatever services the bank provides, that is all the customer can have. Today, you have your information in the bank, let's say budgeting, payments, quicker payments than what the bank is providing, then aggregation of bank accounts in different banks, because customers have bank accounts in many places. All those can be done through a third party, right? So this is that. So without open banking, now with open banking, the fintech app can connect both banks. Without open banking, it is only via the bank app. So if you have 4 banks, you would have 4 banking apps, right? That's open banking. Any questions on that one? That I will ask you a question on this particular lecture, right? Any questions on that one? Right, and then you have digital banks, right? So digital banks is, what do you think a digital bank is? I'm having the slide on, so you can tell me what it is. The reason I ask you to tell me what it is because when you say it, sometimes there are slight points which might change the meaning. That's why I ask you to tell because these, like, it's like open banking. The meaning of the word can be different. What is the difference between digital banks and digital banking? What is the difference between digital banks and digital banking? Anyone? What is the difference between digital banks and digital banking? You're all bankers, so what is the difference between digital banks and what is the difference between a digital bank and a traditional bank? No, no one. Okay, I think y'all know that. Anyway, the important thing, so this you have to know what the difference between a digital bank and a digital banking is. I will leave you to read the slides. Uh, and then you have challenger banks, right? So all this you can read the slides. Since you are not answering, I will just leave you to read these slides. Right. So that is how. So what the important thing with all these, the point here, the connection with fintech and banking is that these digital banks, in open banking, digital banks, challenger banks, they're all using the low end model, right? They're all using the low end model to come to underserved markets, right? Right. So today we are going to look at blockchain technology, right? So blockchain is very simply put, is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system, right? That's very, very simply put what blockchain is. How many of you all have heard of the term blockchain? Or if you have not heard of the term also? Okay. So I'm presuming that you have heard of blockchain. So blockchain is essentially, so it's quite important because blockchain is fast changing the way financial services are provided. It is a back-end solution, right? So the customer, or sometimes even you, won't know that you're using blockchain technology, right? But the system behind it will be using it. But it has certain very crucial qualities that make it very useful for financial services, right? So, which is that it is very difficult to change, hack, or cheat the system. So, it is a very powerful way to catch fraud, right? So very to catch fraud, tampering, to have a good audit system, blockchain is a very good technology, and it's now increasingly being used not only in financial services but in many other use cases, right? So we'll see what blockchain technology is. So blockchain is essentially a digital ledger of transactions, right? So it's like an account. It's a ledger of all transactions that is duplicated and distributed across an entire network of computer systems. So it has this, the way it becomes very difficult to change and hack is because the same copy is kept in many places of a network, right? So you can't just hack one computer, right? You have to change it in all the computers because all the computers will get a copy, right? Each block in the chain, right? So the blockchain, this is how the name comes, contains a number of transactions. And every time a new transaction occurs on the blockchain, right, a record of that transaction is added to every participant's ledger, right? So everyone is on a connected system. Then the decentralized database, right? Now it's decentralized. That means no single person is a is the owner. Of course, there are several types. Because these are computer systems, you can design it anyway. You have public blockchains, and then you can have private and permission, where you limit it to a certain group. But the crux is there are many computers in the network, right? It's not only one computer, right? You can have the logic even in a single system, but the idea is to have it in many places, right? To have a distributed ledger, right? And so blockchain technology is commonly known as distributed ledger technology, but however, it is a type of distributed ledger technology, right? It is an application where you have this blockchain, where you have this blocks on this chain that are connected to each other, right? So we will, and they are immutable, because immutable means you can't change the record because they are cryptographically hashed. Hash means kind of encrypted, right? So let's look at this video.
There's a new and extremely transformative sector of the digital currency market. It's beginning.
Blockchains are incredibly popular nowadays. But what is a blockchain? How do they work? What problems do they solve? And how can they be used? Like the name indicates, a blockchain is a chain of blocks that contains information. This technique was originally described in 1991 by a group of researchers and was originally intended to timestamp digital documents so that it's not possible to backdate them or to tamper with them, almost like a notary. However, it went by mostly unused until it was adapted by Satoshi Nakamoto in 2009 to create the digital cryptocurrency Bitcoin. Now, a blockchain is a distributed ledger that is completely open to anyone. They have an interesting property. Once some data has been recorded inside a blockchain, it becomes very difficult to change it. So how does that work? Well, let's take a closer look at a block. Each block contains some data, the hash of the block, and the hash of the previous block. The data that is stored inside a block depends on the type of blockchain. The Bitcoin blockchain, for example, stores the details about a transaction in here, such as the sender, receiver, and the amount of coins. A block also has a hash. You can compare a hash to a fingerprint. It identifies a block and all of its contents, and it's always unique, just as a fingerprint. Once a block is created, its hash is being calculated. Changing something inside the block will cause the hash to change. So in other words, hashes are very useful when you want to detect changes to blocks. If the fingerprint of a block changes, it no longer is the same block. The third element inside each block is the hash of the previous block. And this effectively creates a chain of blocks, and it's this technique that makes the blockchain so secure. Let's take an example. Here we have a chain of 3 blocks. As you can see, each block has a hash and the hash of the previous block. So block number 3 points to block number 2, and number 2 points to number 1. Now the first block is a bit special. It cannot point to previous blocks because, well, it's the first one. We call this block the genesis block. Now let's say that you tamper with the second block. This causes the hash of the block to change as well. In turn, that will make block 3 and all following blocks invalid because they no longer store a valid hash of the previous block. So changing a single block will make all following blocks invalid. But using hashes is not enough to prevent tampering. Computers these days are very fast and can calculate hundreds of thousands of hashes per second. You could effectively tamper with a block and recalculate all the hashes of other blocks to make your blockchain valid again. So to mitigate this, blockchains have something that is called proof of work. It's a mechanism that slows down the creation of new blocks. In Bitcoin's case, it takes about 10 minutes to calculate the required proof of work and add a new block to the chain. This mechanism makes it very hard to tamper with the blocks because if you tamper with one block, you'll need to recalculate the proof of work for all the following blocks. So the security of a blockchain comes from its creative use of hashing and the proof of work mechanism. But there is one more way that blockchains secure themselves, and that is by being distributed. Instead of using a central entity to manage the chain, Blockchains use a peer-to-peer network and everyone is allowed to join. When someone joins this network, he gets a full copy of the blockchain. The node can use this to verify that everything is still in order. Now, let's see what happens when someone creates a new block. That block is sent to everyone on the network. Each node then verifies the block to make sure that it hasn't been tampered with. And if everything checks out, each node adds this block to their own blockchain. All the nodes in this network create consensus. They agree about what blocks are valid and which aren't. Blocks that are tampered with will be rejected by other nodes in the network. So to successfully tamper with a blockchain, you'll need to tamper with all the blocks on the chain, redo the proof of work for each block, and take control of more than 50% of the peer-to-peer network. Only then will your tampered block become accepted by everyone else. So this is almost impossible to do. Blockchains are also constantly evolving. One of the most recent developments is the creation of smart contracts. These contracts are simple programs that are stored on the blockchain and can be used to automatically exchange coins based on certain conditions. More on smart contracts in a later video. The creation of blockchain technology piqued a lot of people's interest. Soon others realized that this technology could be used for other things, like storing medical records, creating a digital notary, or even collecting taxes. So now you know what a blockchain is, how it works on a basic level, and what problems it solves. Want to learn how you can implement?
So the reason I put that whole video is because it's quite simple and it's easy to understand. Any questions on that one? No? Right. So these qualities that was explained in the video, right? So properties of the distributed ledger, right? So this is blockchain. You have the links to that video, and I have put all the links so you can check all these resources out. So it's programmable, right? So you can make changes, you can put conditions, right? Like the smart contract. Now, what is a smart contract? Smart contract is in the software itself, you put a condition, right? So you have to be very careful. In IT, they use normal, like words that are used in like English words that are used for other meanings, but they put it into the computer programming language, and then it can get a bit confusing. Now, smart contracts basically means that you put a condition, right? So it has to be above a certain value, or it has to check certain requirements before it gets accepted. So those are the sort of conditions that you put to the system to make sure that only what you want is getting included in is validated, right? And then, as we saw, it's distributed, right? So that is how its security is. One way is security is guaranteed, and the other way is it's immutable because of that hashing, because it's encrypted, and then it's connected to the previous block, right? So when it's connected to the previous block, changing it, you can see when it's changed, right? And it's timestamped, right? So when a transaction is done, there is a timestamp on the hash, right? And everyone has to agree, or it's consensus based. If you go on the open normal, so this is also a condition that you have to put into the system, whether it's going to be unanimous or 50% or 2 people or something. You can change, like it's not fixed, but it gives the original blockchain provides a way that if you put in those conditions, it's very secure, right? And tampering with that, you have to be very careful, because you can create sort of loopholes, right? So if it's not unanimous, it's 50% or 2, or if you can even put a central operator, right? So when you put a central operator, you have to be very sure that that central operator is doing the job properly. And then ideally, it's anonymous, right? So you use your actual identity is not revealed. Now that is the biggest problem with Bitcoin or most cryptocurrencies, because it is anonymous, right? Of course, this is also a condition. You can change the level of anonymity, right? So now, what is the history of blockchain? Like, how did it get here? How did it become so big? So in around 2008, after I keep going to the financial crisis in 2008, because much of this course where fintech is concerned, it's all post 2008, right? You have pre 2008 technologies, but really this rise against the traditional banking model, the central bank based, the traditional bank based model, happened after the financial crisis in 2008 in the Western countries. And people lost faith in that system. They no longer trusted their banks and even their regulators to look after their money, right? Because they lost so much of their money there. So because of that, all these alternative systems came up. And but now what we are seeing is a convergence between these alternative systems and the traditional banks. And the traditional banks, who already have a lot of money, are buying up these fintechs and accumulating these qualities and capabilities, right? So anyway, blockchain is also a child of or offspring of the financial crisis, right? So the technologies, now it's an innovation, because if you listen to that video, you will see now what is an innovation versus an invention, that it is not something new, right? So it's taking existing components and putting them together, right? So this whole blockchain, these chain-based data nodes, right? And these hashing, all those things are existing technologies in computer science. And then, existing capabilities. So then Satoshi Nakamoto, who we don't think, no one knows who Satoshi Nakamoto is, so they think it is like a pseudonym, came up with the blockchain, right? For Bitcoin. Now, what was Bitcoin? Bitcoin was the first decentralized cryptocurrency that was launched, right? And Bitcoin had blockchain technology. That was what made blockchain tech. Before Bitcoin, there were many other digital currencies that had been developed, especially in California, where Silicon Valley is, but they were not that successful. But it came at the right time, when people had lost interest or lost faith in their banking system, and this had the security. And what a very important thing that happened was, it enabled proper peer-to-peer transactions, right? So without the need of a bank, right? So you don't need a bank, and you can directly connect to the other person. Now this is because the coin, or the coin with its blockchain could have unique features, right? It was secure on its own, right? So it doesn't need a third party to intervene and guarantee that the funds will be there. And because that is what the intermediary banks do. They say, yes, we have the funds, okay, we will settle it for you. That is the message that ideally goes through the transit systems, right? So that is not necessary anymore, because two people connected on the internet could just directly transfer the money. Now here, even though we can, through our payment apps, though we are doing what appears to be peer-to-peer transactions, they're still going through banks, right? It's not going directly from my wallet to another person's wallet. It is going via the bank because it's the bank wallet that we are holding. But here, this wallet is your own wallet, just like your cash wallet, and you giving a friend cash. This is the same concept, right? Peer-to-peer. So this is what made it really powerful and popular. And so he launched Bitcoin through this paper, right? And the link to the original Bitcoin paper, which is this paper, is here. So you can, if you want to access it, you can access it and read it, right? Now, what they said was, so what Satoshi Nakamoto, now when you're creating a currency, you have to make sure that it works, right? So it has to address shortcomings. And the beauty of, we have to appreciate in this today's lecture, we are going to appreciate the good qualities of Bitcoin and the benefits that innovation brought to the financial services, and how they have thought about many things, right? The next lecture, we will talk about virtual currencies, and then we can talk about the risks associated with cryptocurrencies, right? But today we will appreciate the level of technical thought that has been put into this to make sure that it is feasible, that it in today's digital world, that it is a robust innovation, right? So how now, one issue is if I take a paper money that I have, right, a currency note, and I give it to someone, then I can't give that same currency note to another person, right? Because it has already now left my possession, right? But a digital currency, we can't guarantee whether that same coin is, because these are digitally replicated, right? They are like software codes. I can copy paste, right? If I'm just sending a software code, because it's a digital token, basically, it's like a line of software, right? So if you can just copy paste it everywhere, right? By sharing, you are basically kind of like copy pasting it. Then I can just go and copy paste the same coin everywhere, but only one person will have have the actual coin, right? Whoever uses it first, right? Others all will just be having a piece of code which is no longer useful, right? So this is a problem in the digital system. Now, this is what the service that banks provide, right? Now, when we make a digital payment, when it's going through the bank immediately will freeze that amount, right? The bank won't immediately, they have made a record, okay, 500 rupees to go to X. So that 500 rupees won't be again allocated to Y, right? So the bank is doing that job for us. Now here, how did Satoshi Nakamoto solve this problem of people being able to copy paste the code? He had this hashing, right? This time-stamped hashing, and based on the proof of work. Now, this is where all that we saw, that Bitcoin, the blockchain, hashing, immutable, you can't change. Now, that whole quality was used for this, mainly to avoid this double spending problem, to avoid this fraudulent activity from happening, right? So you can't go and copy paste it here and copy paste it there. Once you send it to someone, immediately there is a timestamp saying now it has been sent to this other person, right? And that transaction is recorded, right? And if that person gives it to another person, that transaction is also recorded in the Bitcoin itself, right? In the code that is considered the Bitcoin, it gets recorded. Right? The history of the transactions of where that Bitcoin is going is immediately recorded in it itself. It's kind of like, if sometimes if you all are in banks, you all may have noticed now these Mudalalis, at the end of the day, they come and give money. They have written things on the money, right? Given to this one, given to that one, and you can sometimes see if it's a note that is going through, let's say PETA, it has a transaction record on it, right? It has now they have already written on the note itself. You can see who and who has now used this note, right? They're not supposed to do that, but they do it, right? And so it is kind of like that. So that is a very sort of a genius way to ensure that this fraudulent activity that could happen in digital currency is avoided, right? So that is why Bitcoin became so popular, because it had thought about many things to make it a very robust peer-to-peer payment coin, right? So that quality is so all that. So hashing was there before. This chain blocks and chains were there before. Proof of work was there before. All these concepts were there before, but these were all brought in to make this a very robust currency, right? And once you have it in your wallet, you can transfer it across, right, to anyone, and that transaction gets recorded. So that is the power of this blockchain technology, right? So you can't, it's very difficult to do fraud with it. So now, then after this Bitcoin came about, there was around 2014, so 2008, 2009, it was just picking up, right? It was just picking up. People were still trying to figure out what this Bitcoin was. It was really cheap. You needed a lot of computer processing power, right, to develop a Bitcoin, to mine a Bitcoin, right? So all these networks are computers, right? So this distributed ledger, they're all computers. They can be people, but they're mainly computers that are processing this, and the proof of work is happening. It's the computer's proof of work, right? That the computer has processed the hash. The hashing has happened, right? And then they realized, once the understanding of Bitcoin increased, they realized that blockchain technology has other good users as well, right? So while part of the world was kind of thinking about, okay, Bitcoin, how do we stop now? Are the banks going to collapse with Bitcoin? Is the monetary system going to collapse? I have missed this thing, very important one on this central bank digital currency. Just it is included in payments. We will. It's okay. So the most popular, as per this PwC survey that was done last in 2020, which is that payments and financial services. So digital currencies, including central bank digital currencies, right? So central bank digital currencies are also using blockchain because of these qualities, right? And then for cross-border remittances, this is again very, very useful. It is being projected that in about 10 years, this will go up to about $433 billion dollars in value, right? This blockchain-based service provision for payments and financial services only, right? Then tracking and tracing products and services. So for international trade, already IBM has this thing called Trade Lanes, right? Let me just show that to you. So let me see whether this will not. So if you go to this, right, it uses blockchain technology. TradeLens uses blockchain technology to connect all the, so you can go to tradelens.com and read about this, right? So in import export, right now, as you all know, if you all have worked in the trade sections of your banks, right? Or you have customers who are in import and export, you will know that you need so much documentation, right? And the documents need to go from one place to the other. Sometimes documents need to get to the place before the goods get there. So there is a lot of documentation and also tracking of products, right, that need to go around. And because of this blockchain, because it has the audit trail, right, because one is connected to the previous transaction, you can trace where the products and services are going. You can also make sure the documents get to the right place, right? To the right person, like on a peer-to-peer, without it going through. Now here again, you have this problem of banks are the intermediaries for international trade as well, right? Now, without sending it through the banks, they can directly send it to the customer abroad, right? So there is also this question of, okay, now are these banks spend so much money, earn so much money by facilitating trade? But what we are seeing is that banks are also, their roles are changed, but they are still involved and they are providing their guarantee services, and they are joining in the blockchain network, right? So they are now getting sort of wiped out of it because there are certain services, especially since they hold the money, right, where the LC is concerned, the bank is still involved in the process, but not necessarily for all the documents, right? And then another very important one is identity management, right? Again, to prove that this person is the right person, right? To prevent hacking, right? Or any fraudulent change to identity. Now, you all know you do KYC. So KYC, we have to check whether that person is that person, right? It's the person who they claim on the ID, right? So one easy way is to maintain the record digitally, so that if they try to hack something or change the picture, change the name or anything like that, that record is immutably there, right? And then for contracts and for dispute resolution as well, especially for land registry purposes, this has become very popular, right? Because you can put the record of the change of ownership. Now, in even in Sri Lanka, we know that there is this problem, and that's why the land registry started its own registering system that is different to the previous deed-based system, right? So that this whole land ownership issue is resolved. So blockchain is a very good technology for that. Insurance is another one, especially for international trade. And then you have many other users like customer engagement, following up on customers, tracking the customers, especially for loyalty programs. All those are applications of some popular applications of blockchain. It can be used anywhere where you want to see an audit trail and you want to prevent fraud or theft, right? They did this survey. I'll just take you to the survey link. Right? So they did this global survey. So this is based on their projections, right? So if you go to this is for the projection for 2030, the use of blockchain, right? The total impact of blockchain in different countries. So if you go to, you can use this, if you are using this link, you can go to these years, and then you can see how their projection are. So now this is their projection for this year, right? We can go and see whether this projection is correct for these countries at this time, because it's a 2020 survey, right? So they've taken 2020 as 0. So they've taken 2020 as 0, and there you can see how they are advancing. And this, I think, will more or less be, I don't know whether it will be faster, because a lot of countries are adopting blockchain for a lot of work. And also now, for instance, if you take Cambodia, they changed their entire payment infrastructure to blockchain, right? And now they're looking at a central bank digital currency as well, right? So in that way, there is a lot of money getting spent on blockchain-based systems. Right. So any questions so far? So what do you think it means to banks? Why would banks want to adopt blockchain? I mean, already some banks in Sri Lanka are looking at blockchain-based solutions. Why would banks want blockchain? So they obviously would want it for the reasons that we discussed, but also the other side is it's a cost, right? Because you have to transfer the existing systems into systems that are compatible to have the information written onto the blockchain, right? So the central bank conducted a blockchain technology sort of experiment, or proof of concept is what you call in IT, where we want to check how blockchain works, right? So we started this off we started studying this from about 2018, right? And we got together with the banking industry and the IT industry, right? All of them came. It was a volunteer project, and so we looked at the different use cases, right? So this is how we can use it in financial services, and we decided to develop a proof of concept for shared know your customer, that is KYC, and to develop a KYC blockchain, right? So what does a KYC blockchain do? It because when everyone is connected to the system, everyone gets a copy of the information, right? So you can share the information very easily, right? So when you can share the information very easily, what is the benefit? So then you don't have to duplicate KYC. Now what happens is, if I want to open an account in a bank, a new bank, or like a second or third bank, I have to go and fill in all the KYC forms in that bank, right? And then third bank also same story. And then I don't I don't update my KYC, right? Then the bank is sending letters saying update your KYC, right? Or is your KYC up to date, right? No one, I don't know. As bankers, do your customers respond to your requests for updated KYCs? No. So what happens is this, because of that issue, there is the business issue of that it's very costly. KYC is very costly, and also it's a compliance requirement. So there is a very good use case in Sri Lanka because KYC, maintaining up-to-date KYC records is very difficult. So therefore, um, um, we decided to use to see how blockchain works on this, and we invited companies globally, and about 40 companies responded, right? And 17 foreign companies responded. This is just to do it free of charge, and so we selected three: one foreign company and two local teams, and we tested it. It was a very interesting experience for us. I was sort of mainly involved in the whole process. And so we tested it with 10 banks. So Amana, Bank of Ceylon, Cargill, Commercial, DFCC, Happy National, HSBC, NDP, Peoples, and Standard Chartered. So all these banks tested it with us, and we found very interesting qualities in blockchain that helps us address this audit issue and fraud issue. Yeah, so we are looking at implementing a blockchain-based shared KYC system in Sri Lanka. We are considering how it is possible to go forward, because it's a useful, because we saw a lot of users, and of course, that activity was also to sort of encourage the banking sector to adopt new technologies as well. And the regulator is also looking at new technology, so they can also not be afraid and carefully implement them. So that's all. Are there any questions? As I said, I'm just going to do this today because we need to pace out what we've finished quite a lot. So just to pace out, I'm just going to stop it here, and next time we will do virtual currencies. And since we have three others, final will be like a sort of overall revision. And if there's anything that we've missed out. Yeah, we'll do virtual currencies the next time. Any questions? If not, we can stop. Are there any questions? There will be a question on this one, because it is not only is it a new technology, it's also a technology that the banks and the central bank have studied and spent a lot of time on, because we just finished it end of last year, so and we're still looking at it. So it will impact the financial services. So this will be included. So if there are any questions, just let me know. No? Okay, then we can stop for today. And I'll inform you, we can probably have a class over the week to catch up, and then we'll have 2 more, and then we'll finish it. Right. Thank you very much.